Your gold did not just dip, it got hit. Silver did not just pull back, it got slammed. Gold dropped 21%, silver fell 41%, and while people were panic-watching red candles, China was not panicking at all. China was moving, quietly, deliberately. A $634 billion shift was already in motion, and almost nobody put the full picture together. By the time this script is over, you are going to see where that money went, why gold and silver sit at the center of it, and why this is not some random pile of headlines. It is a 7-part strategy, already live, and already changing the future price of every ounce in your hands. And once you see all 7 pieces connected, you cannot unsee them. Because the crash distracted almost everyone. That was the point. Screens were red. Emotions were high. Gold fell from 5,568 to 4,400. Silver got destroyed from 121 to 72. Margin hikes hit. Paper selling hit. Liquidity vanished. People looked at the chart and assumed the story was over. It was not over. It was being hidden in plain sight. What happened last week was not the end of the metals story. It was the smoke. The real fire was somewhere else. And that fire starts with one number: $634 billion. Back in November 2013, China held roughly $1.316 trillion in U.S. Treasury bonds. They were the biggest foreign creditor America had. Today, that number has been cut down to $682.6 billion, lowest level since 2008. More than $634 billion pulled out of the American debt market. That is not a trim. That is not portfolio rebalancing. That is a strategic retreat. Think about the size of that move. China did not remove a few billion. China removed the equivalent of an entire wealthy nation from the treasury market, larger than the GDP of Sweden, larger than Switzerland. And the selling did not stop after one bad year. It kept going. 173 billion sold in 2022, another 50 billion in 2023, another 57 billion in 2024, then more than 115 billion through November 2025. This is direction. So ask the question that almost nobody on financial television wants to ask. If that money left treasuries, where did it go? Money does not evaporate, it relocates. And one of the first places it went was gold. Not casual buying, not opportunistic buying. I am talking about 14 straight months of official purchases by the People's Bank of China. 14, consecutive, no pause, no hesitation. They did not stop at 3,000 gold. They did not stop at 4,000. They did not stop at 5,000. They kept buying through the rally. They bought strength. They bought momentum. They bought through fear. That is not how a trader behaves. That is how a state behaves when it has a destination. And here is the part most people still do not understand. China's official gold reserves are still only 8.5% of its foreign exchange reserves. Just 8.5. Now compare that with the West. The United States sits around 66%, Germany around 68%, France around 65%, Italy around 64%. Even Russia, after sanctions forced a strategic rethink, pushed far higher than China. China is still miles behind the reserve composition used by the old monetary powers. That means the buying you have already seen may be the warm-up. If China ever tries to move even part of the way toward Russia's ratio, let alone toward the Western ratios, it would require thousands of additional tons. At current prices, that implies hundreds of billions of dollars in future purchases still ahead. In other words, the marathon has barely started. And China is not alone. Central banks as a group used to buy 400 to 500 tons of gold a year before 2022. Since then, that pace has doubled to more than 1,000 tons annually for 4 straight years. In 2025, total gold demand reached 4,974 tons, the highest ever recorded. So when somebody tells you gold is done because the chart got ugly for a few days, ask them a simple question. Which central bank stopped buying? Name one. You cannot, because the official sector did not blink. Now let's move to silver, because this is where the situation stops being merely bullish and starts becoming unstable. Silver has been in a supply deficit for 5 straight years: 2021, 2022, 2023, 2024, 2025. 5 consecutive years where the world used more silver than it produced. The cumulative shortfall is around 820 million ounces. That metal is gone from the liquid market. It is embedded in solar installations. It is built into electric vehicles. It is locked inside electronics, sensors, chips, connectors, and industrial systems across the world. Consumed silver does not behave like stored gold. Gold mostly sits. Silver gets used up. And the production side is painfully slow. Most silver comes out as a byproduct of lead, zinc, and copper mining. That means even if the silver price explodes, supply does not suddenly flood the market. New mines take 10 to 15 years from discovery to meaningful production. By the time fresh supply arrives, the shortage has already done its damage. That is why the deficit matters. It compounds. And 2026 is expected to be deficit year number 6. Now look at the inventory side, because this is where the paper story and the physical story split into two different universes. Registered silver inventories on COMEX have fallen roughly 70% since 2020. LBMA vaults are down about 40%. Shanghai inventories sit near decade lows. 3 major physical hubs, 3 continents, same direction, drainage. The vaults are shrinking while the world keeps pretending abundance still exists. And then there is the most absurd number in the whole silver market. On COMEX, there are roughly 356 paper claims for every single ounce of registered silver. 356 claims. 1 ounce. That is not a healthy market. That is musical chairs with explosives under the floor. Imagine 356 people holding tickets for 1 seat. The game only works as long as almost nobody stands up and demands the chair. But what happens if even a tiny percentage of them decide they want the real thing? The answer is brutal. The paper structure breaks. Delivery pressure explodes. The illusion gets exposed. And we already saw strange cracks. Reports surfaced of physical silver trading far above Western screen prices in places like Japan and Kuwait. The chart said one thing. The street said another. That divergence is not noise. That is the market screaming that paper pricing and physical reality are no longer the same product. This is why silver crashed harder than gold. Silver's paper market is thinner, smaller, more fragile. When margin pressure hits, silver gets carpet bombed. But the important part is what did not change. The solar sector did not stop needing silver. EV demand did not disappear. AI data centers did not stop consuming electronics. The 5-year deficit did not vanish. The export restrictions did not disappear. The inventories did not magically refill. The price broke. The fundamentals did not. And that is when you realize gold and silver are not the whole strategy. They are the foundation stones. The real structure China is building is larger than metals alone. Metals are not the final weapon here. They are the collateral, the confidence layer, the hard asset base under something much bigger. This is where the 7-piece strategy comes into focus. Piece 1 is obvious now. Sell U.S. Treasuries. Piece 2 is also obvious. Accumulate gold and tighten control over silver. But pieces 3 through 7 are where the story stops looking like a commodity thesis and starts looking like a civilizational redesign. Piece 3 is CIPS, the cross-border interbank payment system. Most people never think about payment rails. For decades, the dominant global route has been SWIFT. SWIFT is not just plumbing, it is power. It is the network that allows the dollar system to function across borders. And it is also the mechanism through which sanctions gain teeth. Then the world watched Russia lose access and watched reserves get frozen. That was the moment every non-Western power received the message. Your savings are not fully yours if the wrong geopolitical switch gets flipped. China heard that message clearly, so China built an alternative route. In 2021, CIPS processed around $13 trillion worth of transactions. By 2024, that figure was about $24.5 trillion, nearly doubled in just 3 years. By mid-2025, cumulative processing had crossed $94 trillion. More than 4,900 banks across 124 countries were connected. This is not a prototype anymore. This is infrastructure. Think of SWIFT as the only bridge across a river. China did not blow up the bridge. China built another one. And once a second bridge exists, nations start calculating. Piece 4 is the digital yuan system, including the cross-border settlement framework often referred to as M-Bridge. This is where the strategy gets even more ambitious. Since 2022, tens of billions in value have moved through the platform. The yuan reportedly accounts for the overwhelming majority of that activity. China expanded its digital currency staffing, built out operations in Shanghai, deepened central bank partnerships, and then one name entered the picture that should have made every macro investor sit upright. Saudi Arabia. Pause on that. the country tied to the original petrodollar order, the country whose oil relationship helped cement dollar dominance for half a century. That country showed willingness to engage with China's payment architecture. Even if the shift is gradual, even if the process is partial, the symbolism is enormous. Because systems do not die all at once. They lose exclusivity first. And when the Gulf starts showing up at China's table, the rest of the resource world notices. Piece 5 is trade settlement. A decade ago, almost nobody imagined 1/3 of Chinese trade being settled in yuan. Today, roughly 1 out of every 3 Chinese trade transactions bypasses the dollar altogether. Every trade invoice settled without dollars is one less layer of automatic demand for the dollar system. That erosion is slow, but slow erosion can still hollow out a mountain. Piece 6 is debt conversion. This part is brilliant because it does not look dramatic on television, but strategically, it changes gravitational pull. Countries like Kenya converting billions of sovereign obligations from dollars into yuan is not just an accounting choice. It changes which currency they need, which banks they rely on, which payment network they use, which power center they lean toward in the future. Debt determines orbit. If a country owes dollars, it must earn dollars. If it owes yuan, it must build yuan relationships. One conversion does not change the world. Dozens of them over time absolutely can. And that leads to piece 7, doctrine. This is no longer a loose collection of moves that commentators can wave away as coincidence. Chinese leadership has now framed currency strength as part of national power, and the next 5-year policy framework prioritizes yuan internationalization as a strategic objective. That means the plan is not ad hoc anymore. It has bureaucratic backing. It has institutional continuity. It has time. Now step back and connect them. Sell treasuries, buy gold, lock silver, build CIPS, expand digital yuan rails, settle trade outside the dollar, convert debt into yuan, formalize the policy. That is not a reaction. That is architecture. And no, this does not mean the dollar vanishes next month. It does not. The dollar remains dominant. It still benefits from trust, depth, liquidity, legal familiarity, and crisis behavior. China still has capital controls. China's bond market still lacks the depth and confidence of the US Treasury market. The yuan has limitations. But dominance is not the same as monopoly. And that is the key distinction most people miss. The dollar used to be an unquestioned only route. Now it is increasingly the biggest route in a world where alternatives are being built. The share of global reserves held in dollars has fallen over time, not collapsed, eroded. And in an erosion cycle, hard assets matter more, not less. Because here is the paradox. America needs credibility to defend the dollar system. China needs credibility to build an alternative. Both paths increase the strategic role of gold. And silver rides on top of that monetary demand with an industrial supply crisis layered underneath it. That is why the metals story survives the crash. That is why the metals story may be stronger because of the crash. Now look at what the major banks did after the damage. Not before, after. JP Morgan pushed targets higher. Deutsche Bank held bullish levels. Citi raised silver expectations. Morgan Stanley reportedly urged heavy portfolio exposure to gold. Read the sequence carefully. Prices got wrecked, and institutions did not respond by abandoning the thesis. In several cases, they leaned into it harder. Why would they do that if last week was the end? Because they are looking past the panic and into the structural forces underneath it. And history says this kind of mid-cycle violence is not unusual in precious metals. The 1970s did not deliver a smooth staircase higher. Gold ripped, crashed, ripped again. Silver did the same. Some of the most explosive final moves in precious metals history came after drawdowns brutal enough to convince ordinary investors the opportunity was dead. That is how these markets work. They throw people off before they run. And this is where I need to say something clearly. The volatility ahead will be savage. Silver especially. If a person cannot handle large swings, silver will emotionally destroy them long before it rewards them. This is not a sleepy bond market. This is a battlefield. But when I lay all of this out together, I keep coming back to the same conclusion. The crash looked like a liquidity event, not a fundamental collapse. Paper leverage got torched. The deep drivers did not change. Central banks kept buying. Deficits kept widening. Inventories kept draining. China kept building. The 7-piece strategy did not pause because traders got margin called for 48 hours. The machinery kept moving. And that should force one final question. If China's gold reserves are still tiny relative to the West, if central banks are still accumulating, if silver has lived through 5 straight deficit years and may be entering a 6th, if there are 356 claims per ounce in the paper market, if 124 countries are already plugged into alternative settlement rails, if 1/3 of Chinese trade is already bypassing the dollar, if debt is slowly being converted, if the doctrine is now official, then what exactly ended last week? The answer may be simple: not the bull market, just the patience of weak hands. That is the real split now, not between bulls and bears, between people who react to the candle and people who study the structure underneath it. Because that is where the truth lives. And the truth here is that China is not trying to detonate the dollar overnight. China is building an exit ramp away from the dollar over time, quietly, legally, incrementally, system by system, ton by ton, agreement by agreement, reserve by reserve. And gold sits under that process like financial bedrock. Silver sits beside it with a supply profile so tight that even a small break in confidence could create a move most people are psychologically unprepared for. That is why what happened matters. And that is why what happened does not end the story. It begins the next phase. So remember where this started. Your gold crashed, your silver crashed, screens went red, fear took over. But behind that noise, a $634 billion reallocation was still pointing in the same direction, toward less dependence on American debt, toward more reliance on hard assets, toward alternative payment systems, toward a future where monetary power is more contested than it was 20 years ago. And in a contested monetary world, gold is not decoration. Silver is not just a speculative toy. They become strategic. This is not about one Friday. It is not about one margin hike. It is not about one ugly chart. It is about a 7-piece strategy that is already live. Sell the debt, buy the metal, control the silver, build the rails, expand the digital network, move trade, change the doctrine. That is the sequence. That is the signal. And if you missed everything else, do not miss this. The world does not need the dollar to collapse for gold and silver to matter more. It only needs the dollar to face competition. That process is already happening, slowly, quietly, but real. And markets eventually price what history is already building. So now I want to hear from you. Do you think gold reaches 7,000 first? Or does silver shock everyone before that and break into a move almost nobody believes is possible right now? And after everything you just heard, do you think last week was the end? Or was it the setup? If this opened your eyes, subscribe and stay close, because the next breakdown is going to expose how major players closed massive silver shorts right near the bottom of the crash. The timing is wild. The paper trail is even wilder. And once you see that move beside this 7-piece strategy, the whole game looks very different.